Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll. You've been listening to All Things Financial with your friend with the answers to all financial matters, Jack Driscoll of Driscoll Insurance and Financial Services. Securities and investment advisory services offered through SagePoint Financial Incorporated, a registered broker-dealer and registered investment advisor and member FINRA and SIPC. Driscoll Insurance and Financial Services is not affiliated with SagePoint Financial, Inc. or registered as a broker, dealer, or investment advisor. You can reach Driscoll Insurance and Financial Services Incorporated at 412-833-1500, and they are located at 2738 South Park Road, Bethel Park, Pennsylvania, 15102.
Welcome back again, everyone, to another edition of All Things Financial. We're going through a series of long-term health care planning in retirement. And what we're dealing with is every type of avenue and opportunity I know of and have run across in my almost 40 years of doing business that can help you navigate through the different decisions, difficult decisions on what do we do if mom or dad has to go into a nursing home? Or what do we do if one of us has to go into a nursing home? Or what do we do if one of us needs care and could have gotten it at home, but don't have enough money to pay for it? So now we have to go into a nursing home. What we're going to talk about today is traditional long-term care insurance. I've mentioned this in almost every show that I've done on this series. This area in financial planning, not just retirement planning, is my single most difficult area to plan. It's very difficult for anyone, I think, to come up with an easy solution. So therefore, most of us come up with no solution at all because we do the do-nothing solution. We hope it doesn't happen to us. But when I talk about long-term health care insurance, I'm talking about nursing home policies. And a properly designed nursing home insurance policy can actually be an anti-nursing home insurance policy. So a lot of people will tell me, I'm never going into a nursing home. I am not buying long-term care insurance because I'm never going into a nursing home. And if I bought long-term care insurance, I've added up, a lot of people will tell me, all the premiums I would have paid, and I could self-insure or I could self-fund because all those premiums I pay, and if I never go into a nursing home, are wasted. Okay. But what are your alternatives? An alternative is if I don't pay it and never go into a nursing home, I saved all that money. Or if I don't pay it and go into a nursing home, I lost all my money, not just the premium portion. So which would you rather lose if you're wrong? Which mistake can you better afford to make? The losing a little bit of money if you're wrong and don't need it, or the losing all of your money if you're wrong? That's how we make decisions in financial planning, folks. We don't try to guess. We don't try to crystal ball what's going to happen in the future. All we do is try to prepare and protect, if things happen in the future, that they have the most minimal impact on us that we could have protected and provided and prepared for. That's all we're doing. We're not trying to guess what can happen, or guess what will happen, or guess what won't happen. Now, in risk planning, there is such a thing as eliminate the risk. That is, it's icy outside, I won't go outside. That's risk avoidance. Risk management, I'll put snow boots on. I might go out and shovel first and salt first. That's risk management. Transfer of risk, I'll call and have someone else go to the grocery store for me. You see how we manage risk? Well, in nursing home insurance, all this is do we want to transfer the risk? And if so, there's a cost to pay to transfer the risk, but the cost might be the smallest cost of all the other options or alternatives that we have. The do-nothing plan is an all-or-nothing plan. We're risking it all. We lose it all, or we lose nothing, or could lose it all. We're leaving it all exposed. All the other options I've talked to you about in this series lead us to long-term insurance, long-term healthcare insurance, nursing home insurance. To me, it's anti-nursing home insurance. If you are able to cared for at home, then I want you to be able to be affording the care at home. That's all. I want to keep you out of a nursing home as long as possible, and maybe forever, without undue burden to your family members or your finances. That's where nursing home insurance comes in. So how do you shop for this stuff? I talked about it in other shows right in the beginning of this series, so you can go back and listen to the beginning of the series. But this industry is a difficult industry. So what we have to do is we have to shop our partners very carefully, and we have to shop our product conditions very carefully. So here's what you look for. Number one, when you buy long-term healthcare, nursing home insurance, you have many choices to make. Do you want to buy a policy that no matter what happens to you, if you go into a nursing home, it pays for the rest of your life? You do until you see the premiums. Most companies don't even offer that anymore, unlimited, because nobody can afford it. The premiums are really high. Now, if it's true, the statistical analysis showing the average length of stay in a nursing home is only 2.4 years, then why in the world would the unlimited plan be so expensive? Insurance companies know how to price risk. If everybody that went into a nursing home revolved around that 2.4 years, you wouldn't see unlimited policies be that expensive or unattainable at all. When we buy umbrella liability insurance over our car and our home, it's cheap. You know why? Most claims never reach it. If it was that in long-term care planning, the unlimited care would be cheap too. But it's not, and it's not for a reason. There's too much at risk for these insurance companies because too many people are in nursing homes way longer than people thought they'd be there. That's what's happening. When you buy your policy, your first choice will be daily benefit or monthly benefit. Your second choice will be for how long or what term. I know that's going to surprise a lot of you. What does that mean? And I'll cover that over this show, and I'm sure I'll run into at least the next show or maybe even longer on this issue of how to buy long-term care insurance. But the first thing is you buy a number. I wanted to pay $100 a day, $200 a day. So all you do is call a nursing home. Hey, if I'm in a nursing home, how much does it cost? Right now, without inflation for 20 years from now, factoring that in, how much is it? $4,500 a month. Oh, okay. That's 30 days, $150 a day. I get it. So I need to buy a policy to pay for today's care if I was in at that level of care. $150 a day. Done. For how long? I don't know. The average length of care is 2.4 years. I guess I'll buy 3. Okay, fine. There's nothing wrong with that decision because there we are guessing. We don't know how long anybody's going into a nursing home. We don't know even if anybody's going into a nursing home. So there we're guessing and gambling. How much, not how long we're going to be in there, or if we're going in there ever. But if we go in, how long do we want to buy protection for before we're again on our own? The average is what anybody wants it to be. There is no average. Some people buy 2 years, 5 years, 6 years, 3 years. You have to decide, and normally you offset, I don't know, what are the premiums? So here are your variables. Your daily limit. Some plans come with a monthly limit. There's no difference, right? $150 a day or $4,500 a month. I don't care. It's the same amount of money. Well, it's not. It's a very complex area in financial planning. Call me. I will help you navigate all the different types of decisions you have to make in this arena. There's a big potential difference. If one company offers a daily maximum benefit and another company offers a monthly maximum benefit, and you're buying the same dollars, there's a huge difference in some cases and no difference in others. Let me give you an example, which you wouldn't know to look for. 38 years in the business, you begin to know what to look for that a novice does not. Almost every one of you listening, this is the first time you're looking into this. A seasoned professional after 38 years, this is thousands of time I've been looking at this. If I'm at home and I have home health care rider on my nursing home policy, that enables me, while I'm at home qualifying for care, to receive the benefit, to get the checks out of my nursing home insurance policy. And I'm not even in a nursing home because I bought home health care. And if home health care is determined to be the same as nursing home, and I have a licensed home health care agency that qualifies, and let's pretend that's required on this so-and-so policy that I'm using for an example, and I went through a licensed home health care agency that qualifies, they'll pay the licensed home health care agency just as well as they will the nursing home. What if all I need is care 3 days a week? If I go into a nursing home, they can't say you can come into a nursing home, or they don't, every Monday, Wednesday, and Friday from 9 to 5. And then we'll send you home. That's not how nursing homes work. People that need to go into a nursing home are going to get that round-the-clock care. At home, you may have a spouse that can provide that round-the-clock care, but you need specific care the spouse cannot or is ill-equipped to provide. And that is maybe dressing, bathing, who knows, getting in and out of bed, all those types of things. You know, I get a 120-pound wife trying to lift a 220-pound husband out of the bathtub. That's just not going to work. So we many times have skilled home health care agencies. They might charge $750 for a day or $450 for a day, but only be needed 2 days a week. So if I run into that situation, I have a monthly maximum benefit of $4,500 a month, but there's no daily maximum. I might get the whole $4,500. Where my next door neighbor, same exact condition, same exact home health care agency, they're taking care of me Monday, Wednesday, and Friday. They're taking care of them Tuesday, Thursday, Saturday. Might only be getting paid $150 a day toward the $450 a day benefit. Ouch. We both have a $4,500 maximum monthly limit, but because theirs is listed as a daily maximum and mine is listed as a monthly maximum, I'm getting $4,500 a month. They might only be getting $2,000 a month, but yet they qualify for maximum benefits. So there's one difference right there, one of many. This is extremely complicated area to shop for insurance. Another, can my daughter quit work and take care of me at home just as well as a nursing home? In many cases, better. But with many nursing home policies with home health care riders, the definitions to be able to qualify for coverage preclude anyone other than a skilled home health care agency from being able to be paid. So here your daughter quits her $45,000 a year job or $85,000 a year job to take care of you and can't receive a dime, even though you have long-term care insurance with home health care riders that would have fully paid $4,500 a month or $10,000 a month, whatever your limit is. If it was a skilled home health care agency, pay zero to the daughter who might actually be much better equipped to provide the care anyway. So we think about these things when we're buying the insurance, don't we? If I'm going to buy insurance, I want it to do the most it can do that I think I might need. If I'm single versus if I'm married, I may think of two different ways to buy coverage. So that's only one area. Reimbursement versus indemnity. And again, I'm not here to educate you to all these nuances. I'm here to educate you as to the surface level, the tip of the iceberg, so that I'm illuminating more than educating differences that you wouldn't know to look for. So reimbursement versus indemnity. Reimbursement is I incurred the care, I incurred the bill, I now have the bill. I either have to pay the bill myself and get reimbursed, or more likely, once the bill is incurred, the insurance company will pay if it's a reimbursement policy. If it's an indemnity policy, especially for those of you with home health care riders, indemnity policies mean if you qualify for coverage, and I'll explain what that means generically in a minute, whether you're receiving care or not, the company will start firing out a check for $150 a day or whatever your benefit is. They're indemnifying you for the need of care, whether or not you're actually getting the cost of care or incurring the cost of care. How do you trigger the benefit? How could an insurance company deny the claims? We have what are called activities of daily living. That is the widely accepted definition. Activities for daily living that qualify your coverage to trigger the benefit. Activities of daily living, they've enumerated, most insurance companies in the whole industry has enumerated. They're usually 5, sometimes 6. Bathing, dressing, feeding, eating, transferring, which is getting in and out of bed on your own. We have cognitive skills which come into play because it wasn't so measurable, where you would see someone be able to do all of those other mechanical things. You could have a caregiver and they'd say, go in and get a shower, and they'd be able to go in and get a shower by themselves. Go in and fix a meal, and they'd fix a peanut butter sandwich by themselves. Get out of bed, it's time to go to bed. Go get dressed. Go get undressed. Those things they could do. But the minute the caregiver walks out of the house, the person, while they could do all those things, are so disoriented and remembering to take their pills and all that, they don't do any of those things. So in fact, because of a lack of what they call cognitive skills, which are mental capacities, they can't do any of those things, but with guidance they could have done. So that's one of the activities of daily living. So most policies say if you cannot satisfy 2 out of 6, 2 out of 5, however the definitions are in the policy, of activities of daily living, or a doctor saying this and that and the other, and sometimes it's required that 2 opinions, your own doctor and a company doctor, correspond on that, then you qualify for the care, that condition that triggers the benefit. Back to my reimbursement versus indemnity. Reimbursement, you still don't get anything out of the insurance company just because you qualify for 2 out of 6 or 2 out of 5 ADLs, which are activities of daily living, that you cannot meet those unless you're incurring costs of care, where indemnity-based policies say you triggered the benefit, it's been determined that you cannot meet at least 2 out of 5 or 6 ADLs, we begin paying, and they begin paying. So they're sending checks out whether you're incurring costs or not. Which comes into another issue that some of us planners say, the reimbursement model, what if we're waiting for reimbursement and the person dies too soon? We left all that money supposedly or theoretically on the table, because some insurance companies will say on a reimbursement model or on a daily benefit model, it still doesn't matter, we'll bank all the extra money that isn't yet used and you can use it later. We, through our experience, say, what if there is no later? I mean, we want to get all the money out of that policy as early and fast as we can, because the person might not make it and we've left money on the table, just like some of our Social Security decisions. So I share these factors with you because when I shop for long-term care insurance, I better know how to shop. And I better know how to distinguish an A-plus rated company that's been in this field for 30 or 40 years from a B-minus rated company. Hadn't I? If we're going to shop for premiums and go for premiums, then we're going to deserve the beating that we take. But if we're going to shop for quality and coverages and components in coverages, it's going to be a much more difficult decision because it's going to be more expensive. But what is expensive? The policy that charged me less monthly and then when I need it isn't there? Or the policy that charged me more monthly but when I need it is there? So we are very careful there. The other thing I'll share with you, and I have a lot of points on this, so I will get back to this in other shows, are we have to do a comparison of all the major providers in the field, the scope of long-term care, nursing home insurance. Again, I refer to it as, I'd like it to be designed to the best of our abilities as anti-nursing home insurance. Now, to have us analyze your situation and all the policies available, does that mean you have to buy it because you're doing the analysis of what is available? You're uncovering all the stones. You're turning over every stone. Should we self-fund? Should we have the kids pay for it? Should we carve out assets? Should we use the bank CD method? Should we buy nursing home insurance? Should we buy life insurance, which I'll get into in a later part of this series, and let it replace assets? Should I buy one of those hybrid policies, long-term care and life insurance? Should I buy annuities with long-term care riders, life insurance with? I'll get into all of that. That's part of the series, folks. We just haven't gotten there yet. But in this whole analysis, doing the analysis doesn't force you to buy. So remember that. You come to us, we do the whole analysis, you look and see what are all your opportunities, and then you choose the one that's best suited for you, and it's different for everyone. All right, we're out of time for today. When I come back next week, we'll continue this discussion on how to shop for long-term care insurance, what to look for, some more provisions in there. Is it tax deductible? What about the Pennsylvania Partnership Program? And more. Thanks again for tuning in. We'll be back again next week.